You see a massive green candle surging upward, so you buy in. But the moment you click buy, the momentum instantly dies. The price reverses, and your stop loss gets hit. Or you experience the exact opposite. You look away from a boring sideways chart, and by the time you look back, you've completely missed a 50-point rally. There is a structural solution to this. It's a specific volatility breakout strategy designed to help identify exactly when a quiet market is preparing to move. This system requires combining two specific tools: Bollinger Bands, which measure the physical boundaries of the price, and the average true range, or ATR, which measures the raw momentum. By mastering the relationship between these two indicators, you can transition from emotional guessing to a repeatable mechanical process. Step 1 is identifying a market cycle known as the squeeze. This is a period of inactivity where energy is quietly building. Think of Bollinger Bands as an elastic boundary wrapping around the asset's recent price history. During a squeeze, these bands act like a contracting rubber band, trapping the price inside a tighter and tighter space. To find this, scan your charting software for moments when the upper and lower Bollinger Bands pinch close together, indicating that price movement has stalled. Notice the wide bands on the left, but as we move to the middle, between points 1 and 3, the channel narrows to a tight squeeze. This indicates a market state that historically precedes significant moves, although the bands do not predict direction. To measure that incoming energy, we need our second tool, the average true range. ATR only measures the pure distance of price movement. It completely ignores whether the market is going up or down. It simply calculates the raw size of the market's steps. Your job is to cross-reference your Bollinger Squeeze with the ATR indicator to confirm that the market is currently quiet. Looking at the green ATR line on the bottom panel of this chart, you can see a flat, low area immediately preceding the first green box. That flat line confirms the baseline level of inactivity we are looking for. Finding a tight Bollinger Squeeze perfectly aligned with a flatlining ATR provides a clear starting point. The compressed spring is loaded. Now we wait for the trigger. The breakout trigger is the exact moment the price physically forces its way out of that established range. Focus on the dashed circle labeled breakout, where the green candle pushes decisively above the black resistance line. You must wait for the candle to fully close outside that boundary. Entering while it forms often leads to unnecessary risk. Acting before that candle closes often results in what traders call a bull trap or fakeout, pulling you into a failing position. Look at the bottom right panel showing the anatomy of a trap. The price appears to break out above the white line, tricking buyers, before immediately reversing. This happens when a move lacks the institutional volume to sustain the new direction. To verify the move, you must check the ATR indicator the exact moment the price breaks the boundary. Focus on the first green box labeled Increasing Volatility, where the ATR line spikes sharply upward. This is your filter. If price breaks out but ATR stays flat, avoid the trade. If ATR spikes, the move is supported by actual momentum. Once you have confirmation, you can enter the trade without needing to chase the initial spike. Notice how the price breaks the orange resistance band, then briefly dips back down to touch it before continuing upward. Entering at this retest point allows for a tighter stop loss, providing a more favorable risk-to-reward profile than entering during the initial breakout. From there, avoid using fixed dollar amounts for a stop loss. Instead, set your stop wider than the current ATR value to give the trade room to breathe during normal fluctuations. By combining an ATR-confirmed breakout, patient entry, and dynamic stop loss, you apply objective filters to environments usually driven by emotional volatility. Recap the four-part sequence: identify the squeeze, wait for the break, confirm the ATR spike, and enter on the retest. This systematic approach replaces the stress of guesswork with clear rules to follow when market conditions shift. Open your charting platform right now and locate just one historical example of this exact four-part setup. Manually backtesting this pattern trains your eye to trust the indicators rather than reacting to emotional price spikes. When you combine price boundaries with volatility metrics, market movement stops being a source of panic and becomes a series of conditions that you can identify and trade with clarity.